Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Friday, June 2nd. Greetings, greetings, greetings all. Now, before we get into the nitty-gritty, please like our channel, YouTube Wealth Press channel, subscribe, and make sure you subscribe to the Telegram channel where we post our videos. Also, I post these videos there personally right after I'm done around 8 and 8:30, so you can get them, you can watch them there real early. Also, post comments and questions below these videos. I actually listen, watch, and respond to each and every one of them. Lastly, I hope all of you have a great weekend. Now, let's get into all the good stuff. As you can see here, the Dow's up about 150 points. The Nasdaq is up about 75 points. And we have passed the debt bill. Finally, it's here. Today we have the employment situation. That's the big report. Now, Fridays, I always get into algos, and I want to show you where algos have been nibbling at. And it's really easy to see it when you look at it this way. This is the equal weighted Nasdaq. And you could see this little bar right here. This is the breakout bar where prior to earnings this week, we had a lot of tech earnings this week. A lot of hedge funds were trying to bid the Nasdaq QQQ up in terms of equal market share. You could see it over here. It's just a lot more prevalent on the equal weighted one, but you could see here how far they took this market. Look at that. Those are algos. And what they were doing while they were taking these markets higher, they were putting a lot of selling pressure on energy stocks, on utility stocks, on consumer staple stocks, on industrial stocks, on basic material stocks. And those sectors appear to have bottomed out. So to me, it looks like we're going to start seeing the opposite effect. We're going to see some selling pressure in the technology, in the communication services, and consumer discretionary, if I could find it on this chart right here. And it looks like we're going to be moving back into basic materials, into healthcare, which had a nice little rally yesterday, definitely into utilities and into the energy sector. So don't be surprised. Don't be surprised if you see a reversal of this taking us all the way down to the base. I'm not expecting anything higher here because there's just no major catalyst for technology. And already the odds of the Fed not raising rates is around, where are we now? Around 70%, as I'll get into it. So what I think the algos are going to be doing is, I think they're going to be fading the technology stocks and the consumer discretionary stocks in favor of weaker stocks. And let me show you momentum studies so you could see the same. Look at the information technology momentum levels right now. They are actually declining. Look at that. Hold on, let me show you. Oops, why do I keep doing the same thing and expecting different results? You see how they look like they're curving and they couldn't go all the way up here? So it looks like there's just not much upside to go in infotech. If you look at consumer discretionary, you will see that consumer discretionary is going down. Now, here's the interesting part. Look at how momentum levels went down, right? Now, look at the sector. The sector swinging higher. You know what that means? A lot less stocks are causing the consumer discretionary sector to rally. Remember, consumer discretionary has Amazon, it has Microsoft, it has Nvidia, it has those stocks. Maybe not Nvidia, but it has a lot of these stocks that have been causing the market to rally like crazy. So be really, really cautious because there's a major narrowing of momentum, as I just showed you a minute ago. Let me see if I could find it again here. Look at that. Only 28% of stocks are trading above the 20-day moving average, but look at this thing. You would never, ever in a million years think that's the case. Matter of fact, it's so hard to find things this morning. Matter of fact, look at communication services. Communication services are in about middle spot, right? Look at that. But look at where communication services are here. Swing highs. So there's a huge disconnect between momentum levels and the number of stocks that are causing technology, communication services, and consumer discretionary to rally. And I don't think that momentum level is going to stay very solid for a long period of time. I think the algos are going to take these three vulnerable sectors to the downside and take sectors like the energy sector, consumer staples sector, basic materials, real estate, and utilities. Look at utilities. I mean, look at this. Look at that. They just don't have that much more to go. There's just not much firepower to the downside of these sectors. Look at that. And they look like they're basing here too. So in my humble opinion, you're going to see a lot of downside, very quick downside pressure, taking technology back down to its base. Consumer discretionary falling down should be around here right now. If it wasn't for like 6-7 stocks, consumer discretionary would be toast. There's 25% of stocks are trading above the 20-day moving average with this momentum level. If that's not algo plays, I just don't know what is. So also, I'm expecting the bond market to rally a little bit more, relieve some pressure from the long bond, which has been under pressure because of this debt ceiling fiasco. So that's the algo corner for today. Now let's talk about the nitty gritty of what we can expect and cause and effect, and then I'll tell you what I'm looking for next week. So passage of the U.S. debt ceiling bill, Washington boosted market sentiment. That's why the Dow and the Nasdaq, the blue chips, are up right now. Investors looked ahead to crucial non-farm payroll report. That report is coming out in about, let's see here. It's coming out in about half an hour, actually exactly in half an hour. U.S. Senate late on Thursday passed the legislation to suspend the government's $31.4 trillion debt ceiling and enforce restraints on government spending going into the election. Tech-heavy Nasdaq once again outperformed major benchmarks as Treasury yield fell amid the Federal Reserve will pause its interest rate increases in June. It may happen, but it's a pause. Meta, see, this is one of the stocks, rose 3%. Energy stocks gained ground, and NetApp had good earnings. Now remember, earnings for techs are pretty much behind us, and so are retail. So the market will have to now look forward to the next fiasco, and right now, there's a huge slowdown in the economy, whether we like it or not. On the negative side, CRM slid more than 4%. The market's literally been driven by NVIDIA last few weeks or last few days. The labor market report on Thursday showed claims for unemployment benefits rose just 2,000 to 232,000. As long as it stays in the low 230s, that's fine. Even 220, 240, as long as it's in there. It's been there for a while. As long as it stays there and doesn't rally, that's a good sign. ADP non-farm employment change came in at 278,000. That's much stronger than 170,000. In an essay published by St. Louis Fed President Bullard, expressed his opinion that current interest rates are positioned towards the lower end of a range that could effectively bring inflation down. There's a 23% chance of a 25 basis point rate hike. This went up to almost 40%. And a lot of the Feds have been saying this is just a temporary pause. Don't think this is over. We're just pausing. And I understand that. They want to see the impact of what they're doing on the economy. Today, we're going to be looking at the non-farm payroll report. We're looking at 180,000. The unemployment rate is really what I'm looking at. And in Europe, we saw gains in mining and real estate stocks leading the market higher. Keep your eye on mining, real estate stocks, non-tech. I want to see non-tech rally over the next couple of weeks, and tech give us a little bit of a slowdown. Shanghai Composite closed lower, rebounding from a 6-month low as the passage of a U.S. debt ceiling bill and optimism that the Federal Reserve will pause interest rate hikes in June boosted risk appetite. Real estate, consumer discretionary stocks rebounded from early lows and closed solidly higher. That's a good sign. In Japan, they're very happy about the U.S. debt ceiling being done, closing at a 3-decade high amid optimism over approval of a deal to lift the U.S. debt ceiling. The whole world is looking for that. We had earnings like Lulu yesterday. We had earnings on MDB, but nothing today that's really important. Today, there's no major earnings. Everything is pretty much out, which also leads me to believe that the tech doesn't have a major catalyst to move higher. Now, as far as sectors, I really like the healthcare sector. I really like the healthcare sector. I really like the utilities sector. If interest rates cool off a little bit, it'll take a little pressure off utilities because there's always a fight between utilities and interest rates because of yield. That's what people buy utilities for. So basic materials, I think, will give us a little bit of a rally. Where's industrial? I think industrial is going to start going to the upper end of the range. I'll talk about that in the VIP room today. And consumer staples, I think, have bottomed out. I think all the stocks that have been going down the last few weeks due to technology are due to rally. And I think technology is going to come down all the way to the base and then some. Because, again, there's not a lot of stocks holding them higher. If you're looking at momentum levels in the broad market, in the S&P, they're not that high right now. In the QQQ, they're not that high either. Now, if you were looking at momentum levels and a chart of the Nasdaq 100, you would think it's at 100 right now. but no, it's not, and it hasn't been going up. It's been just kind of choppy, which is telling us that the number of stocks in the Nasdaq 100, the tech stocks that have been moving higher, are not really cooperating, which goes completely in line with this, with sideways, not this ascending slope we've been seeing. So again, don't get confused and don't get distorted by 6 stocks causing us to go up. Like in consumer discretionary, for example, I've been dying to see this since I started talking about it today. Let's look at the constituents. See, Amazon right now, 26% of this index. Look at a chart of Amazon. I want to show you this. What has Amazon been doing? Now look at consumer discretionary. So 25% of Amazon is this index right now. And it's been doing exactly what Amazon's been doing. See what I'm saying? So Amazon goes down. Consumer discretionary sector craps out. Is Amazon going to stay this strong? I mean, it's barely coming out of, it's in a downslope trend. So again, I'm very, 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 very nervous because you've got a handful of stocks driving this market. And as soon as Amazon and Apple and Meta give out, you're going to see some pain in this market. So you want to keep your eye on these stocks, but I'm telling you right now, momentum levels is the key. Nothing can escape momentum levels. And when you see consumer discretionary 28%, 49% of stocks are trading under the 200-day moving average, and this thing is rallying like that, you're not going to fool me into that. Look at the momentum levels. They're going down. So I'm expecting as soon as these 5 or 6 stocks go down in price, oh boy, it's going to be a bloodbath, I tell you. And you're going to see a lot of market cap move into a lot of other sectors like healthcare, utilities, and also keep your eye on the bond market for a little bit more upside. Before I let you go, folks, I've seen a lot of different trading strategies come and go during my 3 decades in the market. But one strategy that has consistently outperformed is called the M spike. I call it my mean spike. That's right. It's a unique pattern. That's right. It's a unique pattern that can be found on any chart, and it signals when a stock is likely to make a big move up or down. It works to the upside and downside, and it's specifically designed for the stock market, not for the commodities market 50 years ago. I'm hosting a free boot camp today at 1:30 p.m. Eastern Time. It's Friday. It's, what is it? It's the second of, I don't know why this still says the first. Let me see if it'll say the second. I guess not. I guess it's delayed. But today's the 2nd of June. Can't believe summer's here. 1:30 Eastern Time. I'm going live. I'll answer all your questions about this pattern. I'll show you exactly how to use it. No monkey business, no banana in the tailpipes, just good analysis for an hour with Uncle Roger. You do not want to miss it. Follow the link below. Check it out and save your seat. 1:30, the mean spike is coming out to play. And I'll be there with you 1:30 Friday. Follow the link below. Subscribe to our Telegram channel. Post comments, questions in the YouTube Wealth Press channel. And I'll see ya on Monday. Bye.